You know, we often think that the most exciting business moves, like the real masterclasses in corporate strategy, are happening out in Silicon Valley.
Well, for sure. You picture like tech founders in glass boardrooms reinventing the world with software.
Right, exactly. But today, for this deep dive, based on a really fascinating stack of sources we've been going through, we are looking at a legacy industrial company,
Yeah, a heavy metal distributor of all things.
which doesn't sound glamorous, but they just pulled off an absolute masterclass in capital allocation, strategic M&A, and like finding literal hidden treasure on their balance sheet.
It really challenges those fundamental assumptions we have about where innovation and savvy business practices actually live. I mean, we're looking at a company dealing in heavy, physical, old economy materials,
Uh-huh.
muscle metals, but they are operating with a level of financial sophistication that, honestly, you typically expect from a top-tier private equity firm.
Yeah. And just to set the stage for you, we are pulling from their Q1 2026 earnings report, their condensed consolidated financial statements, and the full transcript from their May 6th earnings call provided by court. And the mechanics of what they are doing are just brilliant.
They really are.
And look, if you are tracking the markets right now or just trying to understand where the economy is actually heading, you cannot ignore this. You might look at a metal distributor and think, well, that has no place on my radar.
Right, but that would be a mistake.
A huge mistake, because if you track where this structural steel is going, it gives you this literal geographical roadmap of exactly where the biggest capital investments are being made in real time.
Exactly. It tells you where the money is flowing in real estate, in energy, and tech infrastructure long before the finished products ever hit the market.
That is the perfect way to look at it. So to understand those broader economic signals, I think we first have to look at the sheer scale of the numbers Russell Metals just posted, because the top line boom here is staggering.
It is. In Q1 of 2026, they hit record revenues of 1.418 billion Canadian dollars.
Billion with a B.
Yes. That is a 21% increase from Q1 of 2025
Wow.
and a massive 30% jump just from the fourth quarter of 2025.
I mean, a 30% jump quarter over quarter for a mature industrial company is huge. How does that translate to the bottom line?
Well, their EBITDA hit 124 million Canadian dollars, which is up 44% year over year.
That's incredible.
Yeah, even when you adjust for some one-time items, it's just a remarkably strong operational performance. And their shipments in the service center segment, those were up 32% over Q4.
Which is wild, because that kind of volume movement requires incredibly precise logistics. You don't just magically move 32% more heavy metal overnight.
Right, the inventory management alone is a massive undertaking.
So a huge piece of this puzzle, the catalyst driving a lot of this volume, is the Kloeckner acquisition.
Yes, exactly.
They closed that deal right at the end of the year, December 31st, 2025, for an adjusted purchase price of $94 million US dollars.
Which is where the math gets really interesting. Because in just this first quarter of 2026, those Kloeckner branches contributed 183 million Canadian dollars in revenue
In one quarter.
in one quarter and 8 million in EBITDA. So if you annualize those early results, they essentially acquired this business at an implied multiple of roughly 4 times EBITDA.
That's practically unheard of. I mean, in the M&A world, acquiring a business at a 4x multiple that immediately contributes to your top and bottom line without needing like massive restructure, that's a massive win.
It's a huge win. But what's even more fascinating is the future potential of this acquisition. The sources note that Kloeckner currently operates at a gross margin that is about 300 basis points lower than Russell's same-store average.
Right. So they bought a profitable business, but it's technically underperforming relative to Russell's core standard.
Exactly. And management laid out a very deliberate 3-phase plan to close that 300 basis point gap.
Okay, walk me through the phases.
So phase 1, which is happening right now in 2026, is standardizing business practices. That means procurement, how they approach customers, and aligning pricing strategies.
Getting everyone on the same page.
Yeah. Then phase 2, which hits in late 2026 and early 2027, is regional integration. Basically, fully absorbing these branches into the broader Russell system.
Okay, makes sense.
But phase 3 is where the real margin expansion happens, slated for late 2027. And that involves deploying capital expenditures to introduce value-added processing.
Okay, let me make sure I'm conceptualizing this correctly. It sounds like they bought a fast food franchise that only sells standard burgers.
Right.
It's profitable, gets good foot traffic, but it's pretty basic. Phase 3 is Russell coming in and installing the deep fryers and the ice cream machines. They are adding the high-margin items that use the exact same foot traffic to double the profit per customer.
What is a brilliant way to visualize it? In the metal distribution world, selling standard burgers means simply taking a massive coil of steel from a mill and selling it directly to a manufacturer as is.
You're just acting as a middleman.
Exactly. The margin on that is razor thin.
You're literally just moving heavy things around.
Precisely. But value-added processing, the fryers and ice cream machines in your analogy, means installing these multi-million-dollar laser cutters, press brakes, and leveling lines right at these Kloeckner facilities.
Oh, I see.
Yeah, so instead of sending a raw coil to a manufacturer, Russell unrolls it, cuts it to the exact millimeter specifications, treats the metal, and delivers a kit of parts that the customer can immediately bolt together on their assembly line.
Because the manufacturer doesn't want to invest in their own laser cutters, right? Or hire specialized technicians.
Exactly. They will gladly pay Russell a premium to do all that prep work.
And that is how you close a 300 basis point margin gap.
Yep. Russell historically does a lot more of this high-end value-added work than Kloeckner ever did. So they bought the footprint at a great multiple, and now they're just installing their own higher-margin machinery.
It's textbook execution. So they have this operational growth engine just humming along. But as we move through the sources, the operational side is only half the story.
It really is.
Because the record profits have given management the breathing room to optimize their balance sheet. And that leads us to this literal hidden treasure buried in their legacy assets.
This is where the story shifts from just operations to some really savvy financial engineering.
Oh, yeah.
They announced the sale of a property in Delta, British Columbia. And they got 39 million Canadian dollars in cash for it, resulting in an after-tax gain of 31 million.
Okay, but wait.
But the book value of this property, what it was officially recorded as on their financial statements, was only $3 million.
Yeah, I have to stop you there because the gap between 3 million and 39 million is wild.
Yeah.
How does a company just casually have an asset worth 13 times its stated value sitting unnoticed on the books?
Well, it highlights a really fascinating quirk of historical cost accounting mixed with urban real estate dynamics. Under standard accounting rules, physical properties are recorded at their original purchase price, and then they are slowly depreciated over decades to account for wear and tear on the buildings.
Right.
But the accounting doesn't track the skyrocketing market value of the land underneath those buildings.
So imagine buying like a massive, dusty industrial plot on the outskirts of Vancouver 30 years ago. On the books, it's depreciating towards zero.
Exactly.
But in the real world, the city of Vancouver has expanded outward, and suddenly your dusty industrial lot is prime real estate in a major logistics hub.
That is exactly the mechanism at play here. And this Delta sale, it isn't an isolated event. It's actually part of a highly disciplined initiative following the Samuel acquisition they made back in 2024.
Oh, right.
They bought those Western Canada assets for about $225 million. But since that deal closed, Russel Metals has extracted roughly $100 million in capital just from selling off redundant real estate tied to that original deal.
Wait, so they recouped almost half the purchase price just by selling overlapping properties. That fundamentally changes the implied valuation of the initial acquisition. It makes the Samuel deal look like an absolute steal in hindsight.
It really does.
But, this raises a major question for me. If they have all this hidden real estate value on the books, shouldn't they just liquidate every spare property right now? Like if the market is paying 13x book value, why sit on any redundant land at all?
It's a fair question, but it comes down to management's core philosophy of opportunistic discipline. They explicitly stated on the earnings call that they do not force timelines on capital allocation.
Meaning what?
Meaning they don't mandate a quota to, say, sell 3 properties this year, regardless of the environment. Because they are in a highly cyclical industry, patience is actually their biggest weapon.
Ah, so they wait for the commercial real estate market to be desperate for their specific parcels of land.
Exactly. And they can afford to be patient because their balance sheet is a fortress right now. They have kept their net debt incredibly low. It's around 170 million Canadian dollars while maintaining $500 million in total liquidity.
Wow.
Yeah, in an industry defined by boom and bust cycles, having that much dry powder gives you the ultimate flexibility. When competitors are over-leveraged and forced to sell assets at a discount during a downturn, Russell can step in and dictate the terms.
And while they are being so patient with acquisitions in real estate, they are actively returning capital to shareholders. Like in Q1 alone, they returned $31 million.
Right, that was $7 million in share buybacks and $24 million in dividends.
And they just raised their dividend to 44 cents a share, which is a fourth consecutive annual increase.
And the mechanics of their share buyback program, the normal course issuer bid, are particularly aggressive.
How so?
Well, since August 2022, they have quietly retired 14% of their outstanding shares at an average cost of $38.13. Every time they buy and retire those shares, they are permanently increasing the ownership stake and the earnings per share for every single remaining investor.
It's a combination of all these factors, right? The M&A, the real estate sales, the buybacks. It's all of that combined that pushed their annualized return on invested capital to 22% this quarter.
Which is huge, considering their stated target across the business cycle is just 15%.
Right. They are outperforming their own benchmarks by a massive margin. But to really understand the sustainability of this, I think we have to look at where they are actually deploying this capital geographically.
Definitely. Because Q1 2026 marked a historic tipping point for them.
Yeah, this was fascinating.
For the first time in the company's history, their U.S. platform contributed more revenue, 53%, and a significantly higher proportion of operating profit, 58%, than their Canadian operations.
And for a company that is fundamentally rooted in Canada, that is a seismic geographic flip. Let's unpack the macro environment driving that.
Let's do it.
The sources indicate U.S. market conditions are exceptionally strong right now. Steel mill operating rates are tracking near 80%, which is considered like the optimal sweet spot for profitability. Supply is tight, lead times are extended, and pricing for key products like hot-rolled coil is steadily climbing.
Yeah, everything is firing on all cylinders in the U.S.
But the situation in Canada is practically the inverse. It's all oversupply and lower prices. And honestly, wait, I'm struggling with the mechanics here. The U.S. and Canada share a highly integrated manufacturing ecosystem.
They do.
How does a single North American market result in two completely opposite pricing environments?
Well, the mechanism driving that divide is entirely policy-based, specifically the Section 232 tariffs and the newly implemented derivative product rules.
Okay, and just to be clear for you listening, we are just looking impartially at the economic data here. We aren't taking any political sides.
Exactly, we're just explaining the mechanics. The reality is that the tariffs act as a protective wall around the U.S. domestic market. They restrict cheaper international imports from entering the U.S., which intentionally keeps domestic supply tight and elevates the floor price.
So if you are a distributor like Russel operating inside that U.S. wall, your inventory just naturally becomes more valuable.
Right.
But how do the derivative rules actively hurt Canada? Like, walk me through the actual physical flow of that steel.
Sure. Let's say a Canadian mill produces a basic steel coil. Historically, they might export that raw coil to the U.S., or they might turn it into a derivative product like a finished pipe or an automotive component and export that.
Right.
Well, the new derivative rules put strict caps and tariffs on those finished downstream products entering the U.S. from Canada.
So the Canadian mill suddenly can't send its finished pipe south of the border. It just hits the tariff wall.
Exactly. The product is physically trapped. And because the Canadian domestic market is relatively small, all that trapped steel immediately creates a massive oversupply within Canada.
Oh, I see.
So while the tariffs act as a protective wall on the U.S., pushing prices up, those same North American trade dynamics act as a crushing ceiling in Canada, pushing prices down.
And to make matters worse, the sources point out the risk of Canada becoming a dumping ground.
Yeah, that's a huge issue.
Because global steel from, say, Asia or Europe that gets blocked by the U.S. tariff wall just looks for the next closest port, right? Flooding the Canadian market with even more cheap supply.
Which basically forces the Canadian government's hand. As noted in the earnings call, to protect their manufacturing base from collapsing under this oversupply and foreign dumping, the government has to step in.
With stimulus.
Yeah, with massive capital and stimulus to artificially support the domestic industry and fund large-scale infrastructure projects to literally eat up that excess steel.
And this is where Russel Metals' footprint is so brilliant, because they straddle the border, they catch the organic, tariff-driven margin boom in the U.S. South and Midwest, while simultaneously positioning themselves in Canada to be the primary supplier for these massive government-backed stimulus projects.
They adapt to the policy environment perfectly.
It's amazing. But this leads us to the final and maybe the most crucial question. Whether it's U.S. organic growth or Canadian stimulus, what exactly are these massive volumes of steel actually being used to build?
And this connects this heavy industrial company directly to the most futuristic trends of our time.
Yes.
When people think of the artificial intelligence boom, they think of software, algorithms, microchips.
Of course.
They rarely think of galvanized pipe.
Yeah.
But the physical build-out of data centers required to train and run these AI models is staggering.
Yeah, and this is where tracking the steel becomes a literal roadmap for you. Russel Metals isn't designing the superchips, but they are supplying the physical scaffolding that holds the digital cloud.
The volume of material is immense. I mean, a single hyperscale data center requires thousands of tons of structural steel just for the framing. And inside, you need miles of specialized metal racking to physically hold the servers. Because those servers run incredibly hot, you need endless networks of heavy galvanized pipe and conduit to handle the industrial-scale cooling and electrical systems.
And Russel Metals is shipping that material across both the US and Canada right now.
Right now.
It really grounds the ethereal idea of the cloud into thousands of tons of very real, very heavy metal. You can promise a revolutionary new AI model, but if the steel distributor isn't shipping the racking, that server doesn't have a home.
Exactly. It strips away all the tech hype and leaves you with raw physical execution.
Yeah.
And, it goes beyond just data centers.
Right.
Russell is deeply involved in nation-building projects, too.
Sure.
Specifically, they're supplying steel for Canadian Navy vessels with Irving Shipbuilding on the East Coast. That is long-term, highly reliable government contract work.
And we can't ignore the energy sector either. High global oil prices are driving a massive surge in repair, maintenance, and new capital projects.
Oh, absolutely.
The sources highlight that Russell is seeing this directly through their energy field store segment. They are supplying the booming Permian Basin in the U.S., as well as massive project-based business up in northern BC and Alberta.
Because whether it's drilling for oil or laying conduit for server farms, the underlying requirement is the exact same. Precision-processed heavy metal delivered on time.
It's all connected.
Russell's record shipping volumes are the physical proof that these macroeconomic megatrends are actually executing in the real world.
It really brings everything full circle. We've seen today how Russel Metals isn't just moving metal from point A to point B. They are master capital allocators.
For sure.
They are uncovering massive hidden real estate value on their books because of accounting quirks. They are executing highly accretive M&A like the Kloeckner deal and actively deploying value-added processing to double down on margins.
And they have perfectly positioned their footprint across the U.S.-Canada border to capitalize on the exact mechanisms of trade policy. They capture the tariff-driven pricing power in the U.S. while supplying the government-subsidized infrastructure boom in Canada.
It is a phenomenal example of adapting to the realities of the market rather than fighting them.
It really is. Which leaves us with a final thought to ponder for this deep dive.
Yeah, let's hear it.
As our digital world continues to expand, demanding an exponentially larger physical footprint for data centers, power grids, and cooling systems, are we drastically underestimating the future value of legacy industrial assets?
Oh, that's a great point.
Think about it. What other old economy businesses, sitting quietly on corporate balance sheets with depreciated real estate and mundane logistics networks, are currently becoming the indispensable physical backbone of the next technological revolution?
That is the perfect question to leave you with. Thank you for joining us on this deep dive. Keep looking beneath the surface of the markets, tracking the physical flows behind the digital hype, and we'll see you next time.